If you invest in ETFs, there's a good chance you already have one, if not all three, ETF time bombs ticking inside your portfolio. And this isn't a video about a stock market crash, and it's not about calling the top, it's a wake-up call. Because I'm going to show you what these three ETF time bombs are, how they quietly enter your portfolio without you realizing, and how to diffuse them before you're forced to act. My name's Navar. I'm an investor and I run a portfolio analytics and tax optimization service for investors. And over the last few years, I've worked with thousands of customers managing billions of dollars. And I've seen these exact time bombs go off again and again, usually at the worst possible moment. Since 2020, more than $6 trillion has flowed into ETFs globally. Now that is an obscene amount of capital flowing into the stock market, but it makes a lot of sense that passive investing has become super popular. Other than the active decision of doing the investment in the first place, it makes it really easy. You can use mechanisms like dollar cost averaging, where you don't have to think about timing the market. You just get your capital into an index tracker which gives you average return. But this shift has also created a lot of problems that are not very obvious. Problems that don't matter to you until suddenly they do. And these problems are happening in almost every portfolio I've seen holding ETFs, and often without the investor even knowing they're occurring. So let's get into time bomb number one: concentration risk. Most investors think they're diversified, but their returns are often driven by far fewer companies than they actually realize. Let's take IVV for an example, which is an ETF that tracks the S&P 500. So it gives you the feeling of diversification because you're buying one thing that owns 500 companies in the biggest market in the world, the US. The issue with this particular index and most index trackers is that they are market cap weighted. So what that means is the bigger the market cap, the further up the list they go. Now, if you have a look inside IVV, you'll see that the top 7 holdings are the Magnificent 7. And these 7 make up roughly 40% of the entire index. So when you invest your $10,000 into IVV, for example, 4,000 of that is going to those top 7 companies, and your remaining 6,000 is going across the other 493 companies. And what happens is when you invest into one of these index trackers, the fund has to keep the holdings balanced. So the more money you put in, the more money goes to those top 7 holdings, the greater their market cap, and the cycle continues. So once you're up the top, you often stay up the top longer because money is flowing into you a lot more than it is the other 493 companies. Now, why this matters is the concentration isn't actively chosen by you, the investor. So many investors I speak to aren't aware that they are actually heavily invested in the US tech sector when they think they're invested in the US market as a whole. This concentration is just quietly building in the background, and often people think they're diversified, but all it takes is one crazy tweet from Elon, which can tank Tesla, and it has a huge impact across the IVV or the S&P 500 index. Versus a CEO of, say, company number 401, whatever that is, can make a crazy tweet. No one really cares, and the market barely makes any movement because of that. So you need to be comfortable with the fact that you're heavily invested in those top 7. And maybe you're like me, who loves tech and innovation, and you're completely comfortable with that. But maybe you're not, and you're not happy that a lot of your money is actually sitting with those top 7. So the important thing is not saying that concentration risk is bad. I'm saying that you need to understand where your money is so that you can make decisions that line up with your investing. So the way to diffuse that time bomb is with information and actually looking inside some of these passive investments that you're invested in. Time bomb number 2 is what I call parcel hell. So what makes passive investing easy on the way in often makes it really hard on the way out. So parcel hell comes from doing all the right things in the passive investing world, but it quietly builds up a problem which most investors don't see until later when they're forced to sell. Dollar cost averaging being the most common mechanism for passive investors. So if you don't know what that means, dollar cost averaging means you're not timing the market, you're just putting the same amount of money in at the same cadence. And that might be once a week, once a fortnight, once a month, whatever it is. You're putting $1,000 in, say, every month across a year. You bought into that investment 12 times and the price is averaged out because you've been doing it like that. Now, the issue with dollar cost averaging is it causes an admin nightmare that shows up right when you don't want it to, which is when you've made the decision to sell. Let's say we bought $1,000 worth of an ETF once a month for the last 3 years. What we've done there is bought 36 different parcels into that ETF. So each buy trade is its own date, its own price, its own quantity, and its own fee. So let's say over 3 years we have 36 different parcels and we've acquired 1,000 units in a particular ETF. Now, fast forward into the future and we're forced to sell some of that ETF due to a life event. Say we want to buy a house or you want to buy a car or something like that. If you only sell, say, 300 units, you need to decide, well, which of the 36 parcels am I selling? Because each one is a different price. The other complexity to it is the parcels from way back in the first year are older than 12 months, so they qualify for the 50% CGT discount, whereas parcels that are closest to you, so let's say in the last couple of months, they don't qualify for the discount because you haven't held them for 12 months. So when you sell that 300 units, you now have to calculate the capital gain across all the different parcels that you have acquired. That gets even worse if you've had dividend reinvestment turned on as well, because that gives you another 2 to 4 parcels a year. So that 36 parcels over 3 years becomes closer to 50 different parcels you have to choose from. Now, it might be easy enough the first time you sell your 300, maybe you do a FIFO strategy, which is first in, first out, and you sell the first 300 units. But you need to keep track of which parcels you've sold so that sometime in the future when you sell more or sell the rest of it, you know which parcels have already left your portfolio and which ones you have left. Now, there's an easy solution to this, is you have to keep meticulous records. So I don't care whether you're writing that down on a piece of paper, you're recording it in a spreadsheet, or you're using Navexa to automate all of this for you. I don't care which one it is. You just have to be doing one of these things so that when you're actually forced to act, so say you need to rebalance your portfolio or you are buying a house, for example, and you have to sell them because you need the cash, you need everything ready to go so you don't have to walk into this tax nightmare right when you're already stressed out because you're making a big decision with your capital as it is. So what felt simple on the way in, buying all those parcels, becomes really hard to unwind on the way out. Now, time bomb number 3 is the hidden tax inside ETF distributions. Now, with ETFs, you can owe tax even if you didn't sell anything, and most investors only find out after the damage is already done. And this third time bomb catches people completely off guard because it shows up even when you think you've done nothing. And most investors think ETF distributions are just income. You know, you get some cash, you reinvest it, end of story. But ETF distributions often contain a lot more than people realize. And each year, ETFs send out an annual tax statement. And inside that statement is a whole mix of tax outcomes, not just income. So you can have capital gains realized inside the fund, you can have adjustments that change your cost base, and you can have tax outcomes that don't line up with the cash you actually received. And this happens because ETFs aren't static. They're constantly buying and selling assets inside the fund. And when they do, any gains don't stay inside the ETF, they get allocated out to investors, you, which means you can owe tax on gains you didn't personally trigger from trades you never actually placed. Inside a fund, you thought you were just holding passively. And this is usually where people say, I didn't sell anything. Why is this so complicated? And the answer is simple but unintuitive, is that ETFs don't just pass through the cash, they pass through the tax. And now this is where it links directly back to the second time bomb. Those annual tax statements don't just tell you what tax you owe this year, they also change the underlying math of your investment through cost-based adjustments. So each year's tax outcome quietly rewrites the cost base of every unit you already own. And if you've been dollar cost averaging or reinvesting distributions or holding ETFs for years, those adjustments apply across every single individual parcel. So while your parcel count grows, the internal tax math gets more complex every single year. And by itself, that might not feel like a problem, but over time, those adjustments stack on top of each other. And when you finally need to sell, rebalance, raise cash, you're not just dealing with price, you're dealing with years of accumulated tax history layered across dozens of parcels. So the way to fix this is you need to be tracking all of the AMIT cost-based adjustments you get at the end of every financial year and applying them to each parcel. Let's say in the first year you have your 12 parcels and then you get the cost-based adjustments. That adjusts all 12 of those parcels. In the second year you buy another 12, so you have 24 parcels, and you get your cost-based adjustments again for that year. Well, they adjust now all 24 parcels, including the adjusted ones already from the first 12. Now we go into the third year and we get another 12 parcels, so we have 36. Again, at the end of that financial year, your adjustments now adjust all 36 parcels. So you can see how that starts stacking up really quickly. Now again, the way to solve this is through keeping accurate records. So whether you're using a piece of paper, a spreadsheet, or again, using Navexa, which automates all this for you, you need to be tracking it. Because think fast forward 10 years or 15 years of dollar cost averaging, and you need to sell. Suddenly you have to go and dig up 15 years worth of AMIT statements and apply all of the adjustments in order from start to finish. Nightmare. And that's how hidden tax inside ETF distributions quietly amplifies parcel hell. The tax complexity doesn't arrive all at once. It builds up slowly over time, year after year, and the worst time to discover it is the moment you're forced to act. You're forced to sell because of some external event, but either way you have to make a decision. So my message here with these time bombs isn't that ETFs are bad or that passive investing is bad. These time bombs don't come from reckless investing. They just come from not seeing what's quietly building up over time. So serious ETF investors don't just buy and forget. They understand where the concentration really sits within their portfolio. Am I heavily invested in the US tech sector, for example, and am I happy with it? They also know how complex their portfolio has become. If they've been dollar cost averaging for years, you need to be aware that all of those parcels comes with a tax burden, which is fine if you are tracking that correctly. Then it actually becomes a bit of a superpower because it gives you a lot of parcel flexibility when calculating your tax. Ultimately, serious investors know what a decision will actually cost them before they're forced to make it. So having all the data, knowing where they're concentrated, knowing the tax outcomes means they can act quickly and efficiently, and most importantly, without losing money. And that visibility is the difference between passive investing that stays simple and passive investing that becomes painful at exactly the wrong moment.